Good afternoon, good evening as well. Traditional greetings. This is Joseph Trevisani from Worldwide Markets. Today's topic is one of my favorites because it includes as much psychology as it does economics, statistics, and the history of the world. It's gold. There have been some requests for it, so I'll be glad to do my best. As everyone knows who's been to my webinars before, if you have any comments, criticisms, the oft-requested jokes, or anything else, please type them into the chat and I will take a look at them and I'll be glad to bring up the topic and do the best I can with it. I do not mind interrupting and considering what you all in the audience have to say. I think it makes for a much better presentation when there's participation. So let us go with that. What I have here is a chart of gold and the S&P and the DXY, the dollar index, going back to just before the great excitement in 2008. I titled this webinar, The Three Faces of Gold. Obviously, that is a blatant rip from a movie of the 1950s. I believe it's Betty Davis, called The Three Faces of Eve. And in the, if I remember, I've not seen the movie, but if I remember, the plot is that a woman has three personalities. And they were using the relatively new idea of Freudian therapy, or Freudian theory, to explain it. Multiple personalities is in the realm of psychiatry. Extremely rare, but of course it's fascinating and it makes for great stories. I think, and it's always been mine, I've written on this a number of times over the years, is that you have a tripartite division on the motivations for gold traders. There are basically three types that I look at. The first one I call the Armageddonists, and that's a small, but they get a lot of play, and those are a small group, and those are the ones who think that when the world ends, a basement full of gold, I exaggerate here of course, will be the best insurance against the end of the world. It's kind of my idea that if you have a basement full of gold in the end of the world and anybody finds out about it, you'll be in a lot of trouble. But be that as it may, no one really anticipates the end of the world. What they're anticipating are all sorts of catastrophic financial events whereby gold, not in your basement, of course, but gold as a trading commodity, gold as a store of value, will be extremely valuable. And there's just certainly some truth to that. And you can see the truth from it in the reaction of markets right here. If we take the S&P as a measure of fear around 2008 and 2009, then you can certainly see that gold took off on its great run after the events of late 2008 and early 2009. Remember, throughout all this period here, even while the dollar, of course, at the same period, if you take DXY, had a huge surge up, the dollar being the safe haven currency of choice. Although I know the yen gets a vote. It does get it, but it is a parochial vote in my mind, one limited probably to the Eastern Hemisphere. Either way, the safe haven status of the dollar, though, tapered off very quickly. By the end of 2009, it was back to, where are we on this? To about, which is the orange one? To about 75, a little above about 75, 78 in the DXY. So clearly that was a temporary store of haven. But look at gold. Gold surged throughout the period from 2008 up until 2011. You can really say the end of 2011. Then it plateaued for a while, then it came off. Part of the reason for this are the various aspects of gold. Now I'm going to give you the three of them, then I'll go into what I think is true about each one. The first one's the Armageddonians. They're my favorites. When the world ends, a basement full of gold. The second type are traders and investors who use gold as a hedge against inflation. Now, throughout this period here, when gold was rising so strongly, there was very little inflation. Well, there was some inflation, but inflation was declining. But what was also happening through this period? Let's take a look at the chart. I'll just do this briefly. It's one of my favorites here. Let me put this chart up for you. Come on. Sorry, folks. It is good technology, as I say often, but not perfect. Come on. The screen share doesn't want to come up. Sorry about that. There we go. Okay, there we go. Okay, there we go. So this is the period of the gold here. Gold on here is the yellow. I know this chart's a little hard to see, but I have it up for the QE. What's going up through this period here? Well, that whole period was the new innovation. Mr. Bernanke, the former chairman of the American Federal Reserve, quantitative easing. And what was said, we all remember what was said about quantitative easing, that sooner or later, and many people said sooner, it's going to create horrendous peaks of inflation. Well, it didn't, but we didn't know that at the time. And so while this period was going on here, there was tremendous anticipation for many, because this is what we're looking at. One of the most interesting things about the entire period from 2008 on is that the old analysis doesn't work. It doesn't apply. You don't get the expected results. So for monetarist theory, you greatly increase the liquidity, supply of currency, supply of money circulating, and you should automatically and almost as a law get inflation. Well, we didn't. But throughout this period here, there was a great deal of anticipation that inflation would begin rising. And what's the second face of gold? And that's as a hedge against inflation. So we have the Armageddonists buying gold, partially as a response to 2008, but also throughout this period here, we have the European crisis, the original Greek crisis, where it looked like Greece was going to default, take the euro down, and the EMU with it. I didn't put that on the chart because it would be completely impossible to read. And on top of that, the real driver of world policy has been what the Fed has been doing. So in addition to the residue of 2008 and 2009, you had various crises around the world, primarily Europe, also exciting those who anticipate a much bleaker future and then thereby a much more positive future for gold. So we have the two types. We have the Armageddonists and the inflationistas, as I think I called them in one piece I wrote a couple of years ago. What's the third type? Well, the third type is probably the rest of us, traders. Whenever there's a good trend, let's trade it. Latch onto it. Don't move. So was there ever a better trend? That's almost like trading the carry trade, the yen carry trade in the same period. So you have all three types of gold bugs trading the gold and trading it one way. Not quite straight up, but close to it. So again, we have three types. I analyze the gold market in three parts. And there's also, of course, there's also an industry section. I mean, gold is an industrial commodity. It's used in electronics. It's used many places in jewelry. The industrial commodity part of it, of course, rises and falls with the business cycle and everything else. The jewelry the store of wealth, the traditional portable on your wrist component is relatively stable. I mean, when economies do badly, then of course that will go down. People can't afford it anymore, and it tends to rise and fall more with the actual population that rises with time. Also, one thing that is true, as a traditional store of value, as an economy modernizes, it tends to get less use. So you have sort of a countering effect from modernization as opposed to the rise in population. But I've left that one out because it's a little bit harder to assess. It's relatively small in comparison to these other trends. So we have from the period, let's get a better chart here. That's only 1 year, sorry. Okay, this is a little better chart. Okay, so the white is gold, green is the S&P 500, based in New York, and orange is the DXY. So throughout the period from here, we have all three types of gold interest: the Armageddonists, the inflationistas, and the traders, all pointing in the same direction, pointing up. Now, an interesting thing happened, of course. The S&P continued, and it's the world stock markets, until we get right about here. That is until the middle of 2015. And we know what date that is, but I'll talk about it in a minute. The equities continued higher. Now, for much of this period, US growth peaks and wanes. Europe growth peaks and wanes. China is coming down, and Japan is, as always, almost nowhere when it comes to economic growth. So what is driving this stuff here? It's an interesting question, but I think we all know the answer. And it is part of the reason that gold tapered off. And let's take a look at it here. And of course, it's here. This is the chart of oil, gold, and DXY, because these markets to me are directly affected, as is the S&P, but I just didn't want to put another line on the chart because then we're looking at it and go, what's this? I need my magnifying glass or my trifocals to see what's going on. You have to put a halt somewhere. It's like I was working on our house over the weekend and sanding one of the floors, and my wife asked me if you were done, and I said, as with all old houses, the rule is it's not a matter of when you're done, but a matter of when you stop, because there's always more to do on any particular project. Anyway, let me just check here. Okay, I was just checking the link of the chart because it's on a separate screen. So here we have, of course, the great innovation of Mr. Ben Bernanke and the American Fed, quantitative easing. For the period, now remember the stock chart, which goes here and then continues all the way up to here. Classic and clear sign to my mind that the stocks, and the Fed has said this endlessly, are the recipient purposefully of the Fed's interest rate and liquidity largesse. But it's also clear too that the markets accept that also, because through the period from here to the end of to the summer of 2015, let's take a look at that. So I'll just show you again where it is. Where's that chart? This one, S&P. Okay. You got to switch the charts every time when you do it. Okay, remember the period all the way through August about 2015, when China did its devaluation and caused this initial collapse in the equities. The stock markets continued their role. Gold did not. And the DXY we can discuss, but it's not really key to the issue. There is some, as with oil, there is some spillover translation effect, since gold is priced in dollars and oil is priced in dollars and copper is priced in dollars and everything's priced in dollars, that when the DXY rises, as it had been through this period here, as soon as it became obvious that the Fed was serious about entering its quantitative easing program and at some point beginning to raise rates, something which they have backed off precipitously, and I've never seen such an inelegant retreat of a Fed policy as I have seen now. We'll talk about that in a minute. But anyway, the point being here that the S&P still benefited, and equities in general, still benefited from the Fed role as endless and permanent supplier of liquidity to the world and endless zero interest rates, which gold clearly did not. So let's go back to the other chart, which is right here, and I'll have to switch it over because that's the way this works. Okay, there we go. So look at the effect that the end of the quantitative easing has had on gold. And in my mind, it is a less than serious correlation. It's a correlation in the sense that gold is something that will respond to volatility, to fear, dramatically. It will also respond to inflation. Once the world began to look a lot less fearful, perhaps through this period from 2010 on, if you will, where it looks like things are not going to revert to what they were before, and we're not going to get a tremendous ongoing world crisis, that even though that as a motivation for gold was tapering off, inflation, thanks, at least expected inflation, thanks to the advent of quantitative easing, which in all monetary theory and expected also by the Fed. Although, you know, the initial, what we forget or have a tendency to forget is that these programs in quantitative easing here were not designed specifically, or at least that's what they said, to foster inflation, because inflation wasn't a problem then. They were designed to provide the wealth effect. It is remarkable how malleable bureaucratic justifications for policy are. It's long been my contention that the reason the Fed does quantitative easing is because that's what the Fed does. The Fed manipulates interest rates. It doesn't do anything else because it can't do anything else. So you can make it appear, as the Fed has done, that whatever the problem is, this is the answer. But the problem is the rest of us all sit here and say, wait a minute. Initially, quantitative easing, which is really only interest rate policy by another means, was designed to create the wealth effect. Well, when it turned out the wealth effect, such as it is, did not have very much economic effect, and it certainly hasn't. The Fed's been pumping money for years, and the rate of growth is going down. Although once again, I heard this morning at various outlets of the economic prognosticators, of which I am a very, very minor member, the cabal, not cabal, the guild of economic prognosticators, that, oh, well, you know, the economic growth in the first quarter was not good. The first quarter problem. Nonsense. I don't buy that. There are many other better reasons for it. But anyway, on to quantitative easing, back to quantitative easing. So the wealth effect, which turned out not to be much of an economic boon to anything except the stock market, people already had money in the stock market. It's very simple to explain. Why the Fed expected this is beyond me. People who are involved in the stock market know one thing, most of them, that markets go up and they also go down. And if you don't take your money out, then you don't actually benefit directly because markets will end up going back down. Certainly in a situation like ours, where it's clear to everyone involved in the market, just look at the terror the Fed seems to have inflicted upon itself with 1/4 point interest rate. They backpedaled as fast as they could, and the markets took a huge swoon. Now, part of it could be because of China, but one of the things about the Chinese devaluation, I think, is that the yuan is essentially managed in relation to the dollar. Now, I know people say, well, it doesn't matter so much anymore because they're trading it and it is actually devaluing to a much greater degree against the basket of currencies. I don't really buy that. One, that's a trade-related effect, which is always minor, and the trading effect, the market effect, is still based on the dollar. Okay, so once it was clear to the Bank of China and the Chinese current rulers in the government in China that the Fed was serious about raising rates, suddenly the Chinese devalued massively in August. I do not believe there's a coincidence there. And then they did it again in January. And between the Fed rate increase and its infamous dot plot for rate increases and the Chinese, the markets went bananas. All of the levels in the markets that have been supported by what the governments have been doing quickly started to unravel. The Fed backed off like they're backpedaling up the court in a basketball game and the opposition is doing a full court break. I mean, they reversed so fast, it boggles the mind. But again, back to their policy. The reason Fed does this is because that's what the Fed does. There is far, far more restriction on the Fed's actual ability to affect the world and to make economies work and move than anyone gives them credit for. We all have a need to look and to feel as if someone is in control. That, since Alan Greenspan on an economic level has been the Fed, I personally do not think the Fed is up to it. It's not because the Fed is incompetent. It's because the system is not malleable, movable by the Fed's tools, by in fact, almost any tool. Okay, through the period of quantitative easing, gold continued to rise because the expectations for inflation replaced some of the fear motivation. And for the traders, gold was a train you did not want to miss. And so all of them and everybody piled on through here. Now let's look back to this period here. Remember, gold is the yellow. We had through here a continued diminution of fear, even with the euro. It is apparent that the Europeans and the ECB and the EU and everybody over there will be glad to trade mediocre and non-existent growth for a continued unified euro. And it seems to me that the government on this side is also equally willing to trade away growth to avoid volatility. You know, something interesting. I mean, the Fed has an unscheduled meeting. Is it tomorrow or the next day? And Ms. Yellen is going to meet with the president, I think, today. This is a recent schedule. I mean, there doesn't appear to be anything tremendously dangerous going on in the world. And I don't actually know if this meeting with Yellen Janet Yellen, the head of the Fed, and President Obama, is a previously scheduled meeting. But it's certainly true that what the Fed is doing, their meeting is not scheduled. Well, had not been scheduled. It's not a regular FOMC meeting. So it would appear that something's up, but I guess we'll have to wait and find out. There's not really anything going on in the markets like that seems to indicate that there's a secret crisis. And so I'm not trying to excite those kind of thoughts. Nonetheless, it is curious. But anyway, so through this period here, as I said, the inflation expectations around the world, and primarily in the United States, though, from quantitative easing were strong. And of course, that would keep the value of gold rising, since people use it traditionally as a hedge. One of the things they use a hedge against inflation. It became increasingly obvious in the period of 2012 and 13 that this is not going to happen. That quantitative easing, in the absence of demand, back in the beginning, the Fed was talking endlessly about the output gap, about the lack of demand. And what the Fed wanted to do was boost demand by boosting the wealth effect, by getting people to spend more because they felt wealthier. The problem is people know the difference between feeling wealthier and actually being wealthier. So guess what? They didn't really spend very much more, since markets go up and also markets go down. And people involved in the markets, as I said, know that the level of the markets, just look back here, where I don't have the S&P on here to be at the chart. Sorry. Then markets also go back down. And there's a great suspicion out there in most markets and many traders. Ignore the people in public whose job is to promote stocks. That's a different story. That when the Fed starts removing liquidity, and if things actually haven't improved, and they certainly haven't improved, the average growth in the United States economy since the recession has been about 2.1%. For an enormously severe recession as this one was. Balance sheet notwithstanding, 2008 is now almost getting on towards 8 years ago. The recovery, economic recovery, has been half. Well, half doesn't seem like very much, but the amount of GDP involved in an economy the size of the United States, with 1 or 2% difference in growth, is absolutely enormous. It's also the kind of growth, 4% as opposed to 2%, that makes everyone feel wealthier, that provides for wage increases, on and on and on. So the difference, although it seems minor, just 1 or 2%, is actually huge. So the initial Fed, and I'm talking about the Fed so much because, as it is unfortunate, it makes for a very constant narrative. But the Fed is the engine that is driving this. Many of the levels, there's no price discovery in many markets. There's no reality except what the Fed is doing, and the other central banks as well. I mean, one of the things I said this morning when I was on the tube was that I was asked, do you think the euro is going to go up? And I said, well, it could very well. And the issue is that the Fed is backpedaling as fast as possible. And they're not even being very discreet about it. They're not even being very decorous about it. 2 Fed governors get out there 2 weeks ago and say we could raise rates in April, and immediately they get slammed by Yellen and Dudley, who are out there with far more dovish speeches saying, no, we're not going to raise rates. The world's terrible. And so their fears are completely opposite what they were saying at the initial inceptions, Bernanke was saying, of quantitative easing, when the logic was the output gap, the demand gap, we need to create demand. There was no mention of inflation. As a matter of fact, they didn't want to talk about inflation. Although the gold market still thought there would be inflation, they didn't want to talk about inflation. Why? Because all of the critics of quantitative easing were saying, we're going to get inflation. The Fed goes, oh, no, we're not talking about it. We're talking about the wealth effect. Suddenly, the same policies have morphed into inflation creation. This is what I mean by looking at the Fed as the be-all and the end-all. They only have one tool, lower interest rates. And if we just think carefully about the history of the policy justifications, it changes with the same tool. Initially, we're sponsoring wealth creation with the lower interest rates. Now we're sponsoring inflation with lower interest rates. Well, the wealth effect certainly didn't work, and it's my guess that the inflation effect is not going to work terribly effectively either. The problem is both that the economy has now been thrown off the most important item in a capitalist economy is money. But money gets a price. And you can't determine the price when the Fed is artificially. Okay, but I'm away from that topic. So, let's back a step. The equities are still buying the story because the equities are still the largest, well, except for foreign exchange, they're a very large trading market, and people are still participating based and taking views based on Fed liquidity. But for gold, throughout this period here of 2012 and 2013, where it's clear, one, the world's not about to blow up, or at least not yet. And two, that quantitative easing is not fostering inflation. Remember, we've got zero interest rates in the United States, 0.25%, from the end of 2007 on. And everybody else is doing the same thing. And still there's no inflation. So as quantitative easing 3 gets rolling, gold starts to come off. Because it becomes clear to those who are paying attention and those who care about it. The equities don't care about it. If the Fed is buying, we're buying. Now, I don't mean that literally. But remember the S&P chart. Let's see if I still have it. Oh, no, I closed it. That was really foolish. Okay, let's take a look at the S&P chart again. Okay, this time I'm not going to close it. There we go, the S&P chart. So throughout that period, and once again here, at where we are now, the Fed says we're no longer, we're going to worry, and everybody starts buying the equities again. Let me just ask a question. How long will gold be traded in the world? That's an interesting question because it implies many other things. I would say that gold is not going to go away as a traded commodity, and I would say period. I just don't see, because what has been happening, and oil is an excellent example of this. Let me just bring out one. I think I have here. I have WTI on this chart. We can talk about this for a second because it's a good question. Hang on. There we go. Come on. Okay, there we go. WTI is gold, is the green line here. I've spoken about this surge in pricing here many times before in various contexts. But what it is a deregulated, a decentralized, essentially worldwide trading markets bidding against each other for business. That's essentially what that was. The creation of the ICE exchange in London back around 2000. That permitted unlimited speculative trading and no longer connecting it to the production cycle. And so people could start speculating. So you got many more people participating in the markets, on and on and on. And I think, not to the same degree, but there's a similar idea for gold. That once you liberate something essentially from its constraints, it's very difficult to put it back in the box or in the bottle. And gold being a freely traded commodity with lots of use, if someone tried to restrict, and remember, the only way to restrict finances in our globally connected world is on the basis of a national jurisdiction. There's nobody to go to and say, you know what, foreign exchange is a problem. Let's restrict its trading. You can't do that because there's no place to do that. There's nobody to go to. The only way you can effectively regulate is on a national basis. And much as London forced New York, or the UK forced the United States to change its rules of of oil trading, much the same I think would happen if, say, the United States decided that gold trading and gold ownership, as it did for many years, was something it didn't want to allow its citizens to participate in. Well, what would happen? The business would all move to London. And if not London, someplace else. So I think in a deregulated world like we have now, where there is national income, trading revenues for large and powerful firms involved in the decision, that I don't think you're going to get. It's my guess that gold will remain a traded commodity for the foreseeable future. How far can I see into the future? About 20 minutes. So I'll do the best I can with my 20-minute view. Or maybe I'll give you 8 hours to the end of the trading day. Okay, so back to the other, that's a good way to do it. Just don't close the pictures. And you can bring them up whenever you want. No, it doesn't work. Sorry, we have to go back. Google is not as smart as I thought, which is very unfair. Okay. So the quantitative easing as an instigator of inflation and its relation to gold, it became obvious that gold was not going to get to benefit from a quantitative easing inspired rise in inflation, because inflation was going the other way. Again, going back to the Fed expects to create demand. It doesn't happen through quantitative easing and the wealth effect, yet it still expects low rates, quantitative easing by any name or just low rates, to suddenly sponsor inflation. When again, there's no demand, which QE has not been successful in creating. Whatever you want to say about quantitative easing, and the defense for quantitative easing for now and the future will be, it would have been worse. Well, maybe it would have, but we'll never know. You can make a very clear economic argument that it would have been better. But at any rate, you cannot say that quantitative easing was successful, or zero rates anywhere around the world, that zero rates have been successful at creating economic growth. They have not been. Japan, of course, is the primary example. Okay, so gold now has, of its three groups, three faces of gold, the Armageddonists, the inflationistas, and the traders. Through here, we've got a pretty serious reversal in motivation, in positioning. You can say that the Armageddonists expect Armageddon, and therefore their motivation might not change. However, Armageddonists too like to make money. But for the other two groups, the inflationistas and the traders, what do we know? Well, certainly for the traders, and you see it through here, if you're long and you want to take your profits, this is a very simple proposition, but it seems to be difficult for people reporting on the markets to understand. You've got to sell your position. I mean, I was asked quite a few times at the end of last week by various producers and reporters and stuff like that, why is the yen coming off? The Japanese reduced their interest rates. And I said, well, if you can't find a fundamental answer, look to the markets and profits and trading potential. And that, of course, is the largest answer for what's going on in Japan. But anyway, so here we get what's essentially a profit-taking, long-term profit-taking move in gold, because the motivations have changed. The props of the gold market have altered. The world's not going to end. Inflation is not being created by U.S. quantitative easing, in which case the trend becomes rather irrevocably down for 1 year, more than 2 years. You've had with lots of ups and downs, of course, but you've had a long-term downtrend in gold, as tradable as the uptrend. Actually, it's not. It's a little harder to short gold. So the wonderful gold, and you put a triangle on this. I didn't draw it, but it's a great triangle. It goes up and it goes down. What more could you want from a trading commodity? Provided, of course, you can stand the ups and downs. So if we look at all of the motivations through, let me just check this, hang on. If you look at all the motivations through this sort of midterm period here, where there is still expectations that quantitative easing and what the countries are doing around the world is going to benefit the world economy, gold has a clearer view of that. It's not going to work, because I don't think it's stated in terms of, or thought about for gold in terms of necessarily economic growth for any particular economy. But if you're going to get inflation, it is clearly not going to happen simply from pumping up the money supply. So it has to happen from a combination of money supply and demand. And gold, because gold traders and gold, because let's personify the metal. It's alive and it's speaking to us, and it's whispering in our ear what we should do. Because of its razor focus on focus on inflation, I think gold traders realized much sooner than others that inflation is not going to happen. We're still talking about inflation now, that quantitative easing is going to produce inflation. Nonsense. If inflation starts happening now and you're getting a little bit of a bump up, it's not because of quantitative easing. It's not because of zero rates. It's because there is increasing demand in the economy. We didn't suddenly get, QE has been going on for 1, 2, 3, 4, 5, 6, 7 years of various types. And it's not only the American Federal Reserve, it's the Bank of England to a lesser degree. It's, although a latecomer to the party, the punch bowl party, the ECB. It's the Bank of Japan, the great forerunner in quantitative easing. They didn't call it that forever. And even China, which has stopped for the time being devaluing its currency, but is again throwing money out into the economy, waiting to see what it will stick on. If all that's been going on for 7 years, or some portion of it, it isn't, and we suddenly start to get inflation, it is not because of the current or cumulative effect of all this stuff, all this monetary stuff. It's because of increasing demand. I think we're going to see a faltering in inflation back again, but that's another story. In which case, so if you look here, let's look at the reactions. QE tapering, no effect. Gold continues to go down. Quantitative easing 1, quantitative 2 rising, but not because of quantitative easing in my mind. Quantitative easing 3, longer, bigger, zip. No effect on gold. Gold continues to go down. Here, we get a stronger dollar. This is the DXY. And of course, that is what I didn't put in here. Sometime this summer is when Mr. Bernanke first mentioned, was that summer of 2013? I think it was actually. Over here, the Fed first started talking about perhaps ending QE. There's the QE, yes, that's right. The QE taper is back here. They started, but it was first mentioned about by Mr. Bernanke in May, I think May 22nd, 2013, if I remember. So once it starts to look serious, you get a very strong rise in the dollar. And that adds, but if you notice through this period here, and this is where I'm talking about the translation effect from the dollar, as a pricing currency to oil and to gold. The slope here is the same essentially as the slope here, but the dollar skyrockets. So it doesn't accelerate really the fall in gold. I mean, you could say that this little rundown in gold here is because of this, but I'm not buying it. So the translation effect is small. It can sometimes act as a catalyst, but it's not the producer of major trends in gold and oil and things like that. Okay, so here we have all this going down. Well, what's been happening here? We have this very strong rise from, I think about 1,000, if I remember. Where's my gold price on here? A little above 1,000 to over 1275, if I remember exactly. You can correct me if I'm wrong. I'm not exactly sure on the figures. So what's happening here? Well, what's been going on in that period? Which of the three factors in the gold market are causing a little bit of excitement for the gold market? Well, the first, of course, of the three are the Armageddonists. We have the devaluation of the yuan, a huge shock. Following that, of course, we have the collapse in all the world's stock markets because China devalued its currency 3% or 6%. It's telling you how much the world's markets acknowledge, indeed, if not in rhetoric. And again, I'm personifying the markets. They don't exist, but in the people who write commentary about it. If you look at this period here, when the stock markets are getting hammered, let's go back and look at the S&P. Here comes the S&P. Okay, the S&P. This period right here, right here. We know when that is, January and February. When the S&P is getting hammered. It's future anticipation. It's future pricing. Because first quarter GDP hadn't even been reported yet. Fourth quarter hadn't been reported yet in the United States. So you're talking anticipation, not anticipation of economic problems. There is zero, and it took a while, interestingly. I mean, if you look at this, it took a while for it to translate through to the gold market. The fall happened originally in August. And you didn't really get because this is the S&P right here, climbed back up and then crashed again in January. You didn't really get a response in the gold market until December, until the end of the year. And it is interesting that it took a while for the worry to translate itself through. But what also have you seen in this period here? You have seen what did happen in this period here is the market immediately stabilized. Once this happened, you got a very little more movement down. And then it started back up. But what else happened in that period? So you had sort of a burgeoning worry for the people who are worried about about an oncoming financial crisis. US inflation started to pick up. I mean, the last CPI was 2.3%. I mean, the Fed's chosen, sounds like it's some sort of religious thing, the chosen inflation gauge, core PCE, is at 1.7%. Well, I mean, if that is not approaching the Fed's goal of 2%, now I don't know what's going on. And if the monetarist theory and monetary policy's job is to anticipate this kind of stuff. So if you've risen sharply in 6 months from 1 or whatever it was, 1.2 to 1.7, it looks to me like inflation is getting excited. So either the Fed thinks inflation is going to fall back down, which in fact is not what they're saying. They're continuing to say what they've always said. Inflation over time will reach our 2% goal. At this point, you want to say like whatever, which is not a very decorous thing to say, not a very polite thing to say. But they haven't they haven't changed anything. It's exactly what I've been saying about Fed policy. They have one tool, and the explanation for the use of that tool changes. But the policy doesn't change. Well, if the policy is good for one thing, is this policy good for everything? Can all of the world's ills, or the US ills, be cured by a judicious application of lower interest rates? No. But they're the only thing the Fed has going. That's it. And that's true for the world's other central banks as well. This talk from the various Fed officials of macroprudential regulation, which if ever there was a bureaucratic, meaningless utterance, that's one. I would like to know, and I'm not really taking the Fed to task. The Fed has a very difficult job to perform. The expectations of what the Fed can achieve are far beyond reality. They're far beyond any ability of any financial institution to really manipulate the world. As I said before, we want to pretend that we're in control, but in many ways we're not. Okay. So thanks to the clear fragility of the world's markets to problems in China, you have a rise of concern by gold. You have higher increasing US inflation here by gold. And of course, the last group, the traders, simply go along with anything. Whenever there's a current trend, they're about to join it. So what's true in gold for most of the world, as you can see here, is that the rises are, well, no, scratch that. That's not going to be true. Okay, forget that one. So we have a very sharp increase in gold based on the, once again, concurrence of the three. Now, the advent of the traders will participate in a market when they see increased volatility. I mean, traders who are willing to trade anything, mostly professional traders, hedge funds and the like and stuff like that. Hedge funds get blamed for everything, but there are a lot of other institutions out there trading. They are looking for volatility. And this kind of sharp move right here is the essence, the definition of volatility. So the change in view, primarily on inflation, but also on fear for the world, will attract. Whether it's downward or upward volatility, the direction doesn't matter, will attract. Okay, so that's the explanation for this rise. Now, what do I think we're going to see from here? As in the oil price, this rise to gold and oil, to me, is an overabundance of both volatility and attraction to traders. In other words, it's not going to duplicate. So whatever move you get back up in gold, you're not going, in my mind, to get this rapid increase, certainly from here to here. And the same is true of WTI. Another volatility attracted currency, or commodity, sorry, a trading instrument that attracted a great deal of volatility and many more traders because of its sudden surge. Okay. So what do we see in gold? Now I'm going to bring up I have two charts. We have a 1-year value in gold. We're going to talk a little bit about technicals. Not a huge amount, but here. Okay, so this is a 1-year chart in gold. And it's clear that the support and resistance, the one level that over the past year has made a difference has been 1200. And this should be clear from any chart. I'm drawing this. These are candle charts. And the RSI here is, in my mind, a deceptive value. I put it up there because I know a lot of people follow it, and I use RSI as well. But when you get this kind of incredibly rapid rise in a currency, it inevitably produces an overbought signal. And it's overbought in this reference point, meaning that gold immediately went right back down. So as far as that goes, it's correct. But from a fundamental point of view, it did not end up being overbought because it bounced right off the approximately the 1200 level and back up. There aren't a lot of signposts in the 1-year chart. We haven't been here in more than a year. So let's take a look at the 2-year chart. And here we go in the 2-year chart. Is it up yet? No, it is not. I think you folks can see my picture when I don't have the charts up. I'm in a suit because I had to do a TV spot this morning. Okay, so back here. So this is a 2-year chart, and we have some reference points here that I think are of value. But you know, for gold, which is probably less true than others, because you have other trading commodities, because you have various types of motivations. For instance, the only people who are trading euro are people who want to make money trading euro. The number of people who plan on holding the euro because they think the world is going to end is nil. On a volume basis, the number of people who are buying or selling euro because it's based on a trade flow is minuscule. So the majority of people in the euro are not in this as an investment. They're in it to make trading profits. So that means that the trends can be far more volatile than you might say in gold. Not individual volatility, of course. If you look at it on a long-term gold chart, somebody who bought gold in 2000 is still making tons of money, and they're not going to be likely to dispose it for people. You're not going to get that type of position holding in the currencies. Be that as it may, if you look for other levels in gold, if you're looking for a support in gold, it looks to me that we are sitting on that right here at 1255. Now, it's not a terribly strong level. There are some tops through here. You have this peak back here. But it looks and feels to me that gold's upward potential from here is stronger than its downward potential. Because if there's one thing that we're learning, and I'm talking primarily as a hedge, and I don't mean necessarily a hedge, you could call it a safe haven. You could also call the Armageddonists a safe haven traders. That the one new development in sort of the world economic picture for the rest of the year has been the fear of the Fed. I don't mean people are afraid of the Fed. I mean the Fed has developed some fear. The astonishing, in my mind, backtrack of the Fed from a rate increase in December to 3 months later, 3.5 months later, saying nothing. In other words, the Fed is agreeing with the markets. Things is not kosher. Things are not right. There are problems out here. This can only sponsor further faith in gold for the end of the year. So from a fundamental point of view, and then this is why I have some resistance and support up there, but I don't think it's the primary motivation. I don't think technical trading is the primary motivation, especially in a world so utterly dominated by the utterances and wisdom of central banks. That the key change has been the conversion of the Fed. I mean, do we expect to see the Fed going back in next month or the month after, hey, say things are great, we're going to start raising rates again? I don't see it. And so based on that, I think gold's potential, and I would say the next quarter and probably till the end of the year, is on the upside. I expect further problems in the world economy, and I think gold will benefit from that. Okay, folks, I thank you all for listening. I hope we've run about a little more than an hour. I thank everyone for attending. I always take it, as I say, a great compliment that people take time out of their day to listen to me. I would like to thank FX Street and Maurice Carrillo and Adinda for their help in putting this on. I will put my email up there. It's just my name, Joseph Trevisani at gmail.com. And I hope to see you all again next week. I'm not sure of what the topic will be. If anyone has any interests, please send them to me, and I will put up. Adinda, I'll put up my email in a second. This one is a little more difficult to use for doing that. Anyway, my email is jtrevisani@worldwidemarkets.com. Again, thank you all very much, and everyone have a great day. Take care.